Hey there, and welcome back to another episode of Approved AF, the mortgage licensing podcast. I'm your host, Catalina Stepanov, and today we are talking about surety bonds. Most brokers know that they need them, but few really understand how they work. Today, I'm joined by Chris Sturdivant, VP of Business Development at National Notary Association, to demystify surety bonds and share exactly what brokers need to know to protect their business and stay compliant. Whether you're just getting started or scaling into multiple states, this conversation will give you practical insights that you can use today. So let's jump in. Hey, Chris, welcome.
Hi, Catalina. How are you?
I'm great. How are you doing today?
I'm doing great.
For people listening at home who don't live in this day-to-day world of ours, can you give us a quick version of who you are and what you do, and why surety bonds are just such a big part of the work that you do?
Yeah, so my name's Chris Sturdivant, and I'm the Vice President of Business Development at the National Notary Association and NNA Surety Bonds. And basically, we provide surety bonds for mortgage companies to become licensed. We do that in all 50 states. We also do that for notaries in all the states that they need one. And so basically, a surety bond is a financial guarantee or a liability that's required by states, sometimes even at the county level, that really protects the public. It doesn't protect the mortgage company at all. It protects their customers or anybody that's potentially harmed by their actions. So it acts as a financial guarantee. And you can purchase a surety bond for a fraction of the cost versus having to put cash up on deposit with that government entity.
Awesome. So in layman's terms, a surety bond is more protection for the consumer than it is for the mortgage company.
Absolutely. It's a liability to the mortgage company. So it provides no protection to the mortgage company. It's actually a liability to them. So if there's ever a claim made against that bond, the bonding company would seek reimbursement from that mortgage company owner.
So how does that differ from insurance?
So insurance is going to protect the actual mortgage company if it's a covered peril, right? So if there's ever if a mortgage company is ever sued for an unintentional error, that's where their insurance company would come in and protect the mortgage company. There's certain cases, for example, in fraud, where the bond would still pay out because if a consumer is defrauded by the actions of a mortgage company, the bond pays out that consumer. But the insurance company, if there's an insurance policy, would deny that claim because fraud is not one of their covered perils.
So what are the most common types of bonds brokers need to be thinking about?
For the most part, what we see and deal with, it's all license bonds. So depending on your state, the state will have a license requirement, whether you're a broker, whether you're a lender, whether you're a broker and lender. There are some states that require the individual MLO have a bond. So the most important thing I would say to figure out is just what license type you're obtaining and learn what that bond requirement is for that license type. Most of the bonds these days are all issued in the NMLS, so it's very simple for us to issue. The industry has evolved so much in the last 6 years from once the bonds started being issued in the NMLS to insurance companies are very aggressive now. In fact, we have products that you can purchase the bond online in 30 seconds and you're done without any financial review or agreements to be signed. So it's become a very, I won't say commoditized product, but it's a very easy product to write for our mortgage companies up to a certain limit. But it's become easier to obtain and much cheaper to obtain in the last 3 years.
And is it true or false that the NMLS has officially moved every bond to a electronic bond?
That would be false. You still have some states that are dealing with paper. So like New Jersey, Pennsylvania, those are still paper bond states. Arizona is still paper. In Michigan, one of their types of bonds, the MLO bond, is still paper based. But what we have developed on our site is even in those paper bond states is as soon as you purchase the bond, you can download a copy and it's executed, and the states are accepting those. So you can have your bond still in 30 seconds. Just in those paper bond states, the state will require you to either mail in a copy of that bond, or in some states, they'll actually allow you to upload a PDF copy to the NMLS system.
And what role do state regulators play in setting the bond requirements?
I think it probably just depends on, loan volume, average loan size balances, what the liabilities are. I'm not sure exactly how states determine the amount they need. I would like to think they probably use some actuarial science to determine what the proper amount is. But we are seeing bond amounts increase. I think this past year we saw Minnesota go from 100,000 to 125,000. Mississippi's recently increased their bond amount requirement, I think, all the way up to 250,000. So it just depends on the state, and my guess would be it's determined by what their actual losses are.
And then, kind of more on the practical side of things, what are some of the biggest mistakes that you see companies make when it comes to getting a surety bond or maintaining a surety bond?
I would say the biggest mistake I see is just purchasing the wrong bond type, which is not that big of a deal. It's not that big of a mistake. I mean, if you purchase the wrong bond type from us, we allow you to return it and then refund you and then purchase the new bond. Some bond companies you can't obtain a refund from because the bonds are considered 100% earned once they're purchased. But just knowing exactly what license type and bond form you need is critical because we can't just interchange them. So that's probably the number one thing I see. And then I would say number two is just understanding that the bond is a liability. It's not an insurance policy for the mortgage company. I would say that's probably the biggest misconception that I see in the industry. And then, other than that, I would just say that if there's ever a claim made against your bond, don't ignore it. We have seen a few claims. Some of the claims have come from states themselves when mortgage companies don't pay the taxes that are due or the fees that are owed based on their volume. The states can file a claim against that bond to obtain their payment. So if there is a claim, you don't want the claim to hit your bond. You want to take care of that right away. You're going to be facing the liability anyways. But if the claim is paid on the bond, most likely you're not going to obtain a bond anywhere else, and all your bonds could be canceled, which will cancel your licenses. So don't ignore it.
Yeah, that sounds like a bigger deal than maybe some people realize.
Yeah.
So what happens if a broker doesn't keep up with their bond being active and they let it lapse?
So nowadays with the NMLS, I mean, once that bond lapses, the bond will be canceled in the NMLS, and that will probably put the license into suspense status. So it's pretty instantaneous. Some of the paper bond states, a cancellation notice is mailed to the state, and then the broker will receive a letter from the state that they have a bond deficiency, and the license will be canceled.
Dang, yeah, you're done. You're dead in the water, out of business. Got to get that. Got to keep it up to date. Can you explain how bond amounts are determined and why they would sometimes fluctuate? I know you mentioned loan volume and things like that, but is there anything else you'd like to share on that?
Yeah, it's mostly based on volume. So every state will have a different amount. A lot of states it's just a flat amount. So the amount won't vary, but some states it will vary based on your previous year's funded volume. So if you're a brand new company, they say you have to start at X, maybe it's $100,000, but then based on a scale of your previous year's funded origination volume in that state, you may be required to get a higher bond amount or maybe even decrease that bond amount. So that's how they determine it.
So if I am a mortgage company out of Michigan and I have my Michigan bond, that covers me for all the states, right?
No, they are state specific. So if you're going to be licensed in all 50 states, you're going to probably need bonds. And there's, I think, probably 40 states that require a bond. maybe 41 or 42. So you can't utilize the bond for another state. You also can't use it for another activity. I mean, we get questions all the time of, I have a notary bond in Michigan. Can I use that for my mortgage license? And no, it's a completely different obligation and obligee.
Okay. So for somebody that is looking at their mortgage company and looking to expand it into multiple states, what would you say is the smartest way for them to manage their bonds without losing track of them?
Um, I mean, the NMLS system does a really nice job of listing all your bonds in there, right? So that's a really nice online tool to have. Keeping a copy of the actual bond when you purchase it's probably a good idea. But the NMLS system just makes this so much easier. And it's really why we got into the mortgage bond business itself. I mean, our parent company is the National Notary Association, and it's been around for 60 years. But we provide the surety bonds that individuals need to become a notary in all 50 states. And I think when it was probably 2017, 2018, somewhere in there, the NMLS system announced that they were going to start accepting mortgage bonds in their system. And I just thought at the time, I'm like, that's interesting. And that's going to really change the way insurance agencies operate. I was a wholesale mortgage account executive in my previous life before I landed here 15 years ago. And so I understood the NMLS system really well. And I just thought this is going to be a real opportunity for us to be able to provide our bond services in all 50 states to a new class of professionals. That's really kind of what inspired us to launch NNA surety bonds. And then probably within the last few years with some of these new products that we've been able to obtain access to and the online fulfillment, it's really grown for us. But it's that NMLS system, in my opinion, as an insurance agent, is so efficient for surety bond management.
And then when it comes to renewals and renewing bonds and things like that, what is the number one thing companies tend to overlook in that space?
It's really, you just have to pay the premium when they're renewed.
Yeah.
I mean, historically, and for some of the large accounts today, still, you do have to submit annual financials. And so even though mortgage companies had great years in 2020, 2021, 2022, 2023, 2024, even 2025 mortgage companies are struggling. And so the financials don't look as strong as they once were. And so several insurance companies have declined to renew bonds for customers based on their financials. And so that's pretty important to maintain. I mean, we have a product where if you have under $1 million in bond liability, we don't require any financials. And so that makes it really simple. You just have to make sure you pay the premium on time. And that's all done electronically via email. But if you have more than $1 million in liability, our underwriters still want to see the financials every year. But it's not just an automatic guarantee, like you're going to be able to renew your bonds. You do have to qualify every year once you get to that point.
And a pro tip for any of the mortgage companies out there, do budget for those bond premium renewal periods, because sometimes you lined them up with multiple states and they all come due at the same time. So that can definitely eat into your budget if you're not mindful of it.
Correct.
So, Chris, are there any warning signs that company bonds could be at risk of cancellation? Obviously, the NMLS is a good indicator of that, but what do they do, or what does your company do when they get some kind of alert?
Yeah, I mean, we typically notify companies 3 months in advance of their renewal date of like, hey, you're approved for renewal. You just have to pay the premium anytime between now and the date of expiration. So you can manage your cash flow based on when you want to pay it. If there is a problem when we can't renew the bond, we contact you typically 3 months in advance, and we'll go search for another market, and we'll find another insurance company that may be willing to write the bond for you. And that happens sometimes. Sometimes insurance companies will come in and out of the market, so we'll find a new home for it if there's a non-renewal.
And then, like Chris mentioned earlier, inside of the NMLS, it will give you these alerts. So if you are ever wondering, you can jump into your company NMLS to review your surety bonds all in one area. And then also turning on your notifications within the NMLS will let you know what is coming due and when. And those are very important to pay attention to. No one wants to be surprised with a deactivated license when it could have easily been prevented by, answering an email and not letting it affect their bond. What advice, Chris, would you give to companies who are scaling quickly and they're worried about their bond requirements and keeping up with what they need as they do these expansions?
Our products allows them to purchase bonds their first year without any underwriting, up to $250,000, which is very convenient. It's great for startup companies. When you get to that second year of renewal and the insurance company wants to see financials to qualify for the renewals, I mean, from a basic rule of thumb, you kind of want to maintain a balance sheet where you're going to have, short-term liquid assets at about 10% of what your bond liability is. That's just a kind of a general rule of thumb. Doesn't mean you can't get your bonds approved if you have less, but that's a general rule of thumb that you can kind of manage your balance sheet with that. Also, just make sure, I talked earlier about claims. Don't ignore them. You don't want to have a claims history. If there is a claim that's ignored or paid out, it's going to be really tough to place you with any insurance company out there.
Yep. Keep your guys' noses clean on that one. What is one thing that a new broker owner should do today to get ahead of a bond headache in the future?
It's not that big of a deal these days with how aggressive some of these surety bond companies are. If, let's say, for example, a mortgage company allowed a couple of states bonds to lapse because they don't want to invest the money in it, because volume is low right now. If you want to get up and running in that state again, we can issue bonds in 30 seconds now. So that part's fairly easy, as long as you have a clean claims history. But if you do get to that, amount where your aggregate liability is greater than $1 million, if you're going to be licensed in multiple states to where you get to that point, you're going to want to make sure your financials are in order. And we can take self-prepared financials. It doesn't have to be CPA prepared, but you'll want to prepare for that. Also, once you get to $1 million, the insurance companies will want to see an indemnity agreement executed, and that's sounds easier than it is. You're financially guaranteeing all this liability. If you're married, you can expect that your spouse is going to have to sign the indemnity agreement and have that document notarized. So that takes some time, right? That might slow the process down if you get to that $1 million threshold.
So you keep telling me that you guys can issue me a bond in 30 seconds, and that just sounds too good to be true. So talk to me about the system that your company has and what makes it so easy and friendly to use.
Yeah, that was exactly Ryan Kinch's message to me when I was first reaching out to him a couple of years ago. He said, "It sounds too good to be true, Chris." And I said, "I know I'm a stranger to you, but you got to just check this out." I think that overall the loss ratios of mortgage license bonds is very low, and it's a very attractive insurance product. The carrier that we utilize this for is Arch. A lot of people in the mortgage industry will recognize Arch because they're a big provider of private mortgage insurance, or PMI. So I would say that the company is very familiar with the mortgage space. They like the mortgage space and mortgage industry. And so they've offered us this great program. We've worked pretty hard to make it very available on our website to be able to purchase very easily. And then once you purchase it, you get a receipt right away. It does take, if it's a new bond, it takes us about an hour to get it into the NMLS system once it's purchased. But it's significantly easier than the days of old where I would have to collect financial statements from a company. I would have to collect indemnity agreements. I would have to collect owner resumes. I'd have to go through an underwriting process for a day or two or three. We would have to physically mail the bonds to you via snail mail or pay for a FedEx. So it's taken that process from a week long at least, and a tough qualification, to You just buy it and download it and you're done. It's extremely simple, and technology and some of these insurtech companies out there that we utilize are fantastic. I mean, they've completely changed the game.
And once a bond is issued in the NMLS, that doesn't necessarily mean that's it done. The company owner needs to go in and sign off on the bond and mark it ready for the state regulator. So be sure that you hit those buttons and follow through on all the steps. Otherwise, it's just going to be sitting there waiting for you.
That's correct.
So what pro tip would you give companies working with other bond companies, something that they might not even think to be asking?
I think that number one, probably just ask what the renewal process is like, so there's not surprises. I mean, we were working with other insurance carriers and had some big national accounts, and when 2024 or 2023 came around and the mortgage company's financials were showing a loss, they canceled the bonds right away. I was able to place them with another insurance market, but you'll probably want to have a very good understanding of what the renewal process is going to be like and what kind of paperwork you're going to need to provide based on your aggregate bond liability. The other thing I would say is take a look at the price. When I first started back in 2018 marketing our mortgage products, I probably had the same product that every other insurance agency out there in the world had. And we didn't have a lot of traction, to be honest with you. The most common rate was probably a 1% rate, or in the surety bond world, we refer to that as $10 per thousand in liability. So a $25,000 bond would cost $250 per year. Then the industry got a little competitive and it moved down to like a $750 rate. And I had a $750 rate, and I thought I would get all this mortgage companies. I would be able to provide them some cost savings and start working with more mortgage companies. But it was the same product that everybody else had. But now I would say that the going rate is probably at $6. And so we've been able to save our mortgage companies 25 to 40% over the last 2 years, which is significant savings.
That is significant savings.
In a market, too, where volume is down significantly. And so the ability to be able to provide meaningful cost savings, as well as just how much easier it is and it doesn't take as much time. It kind of leads me back to your statement of it sounds too good to be true. And it was. I mean, we went from, it wasn't too good to be true, but it's that evolutionary, I would say, in how the insurance market has just evolved to provide a competitive product. I know our agency, we went from working with maybe 30 to 40 mortgage companies, to now working with over 500, just because of these productivity gains that the software has provided and the insurance companies have provided us.
I can say because of the benefits of the platform that you guys use, the speed of which we can execute and get our clients bonds, and the price and cost savings. This is what makes you guys one of our preferred providers. And we're very excited that we now have this partnership with you guys. And so are our clients. They're really enjoying that. So thank you for everything that you do.
Well, our goal is hopefully to make surety just as easy as possible as part of the licensing process. So if it comes to surety, there's a lot less to worry about today than there might have been 2 years ago.
So for a broker listening in who never thought that much about a surety bond prior to this conversation, what's one thing that you would want them to walk away from this conversation knowing?
I would just say knowing that it's a liability to you. So know that you're personally liable for the bond in case there's a claim against it. And then the second thing is I would just say, I wouldn't be afraid of expansion. If you're worried about expanding and gaining bondability to meet the requirements to offer mortgages in other states, that part is significantly easier today than it was 2 years ago.
And so for anybody who has additional questions or they want to connect with you, where can they do that?
Just send me an email, give me a phone call. I mean, our website's NNASuretyBonds.com. I mean, you can find me on LinkedIn. It's very simple. We have a few different ways of obtaining the bonds. I can help you out and push the links to you or your customers. If you want to self-service your own bonds, I'm happy to show you how to do that. It takes about 30 seconds to learn how to do it. Then you probably don't need me again. So it's pretty simple.
Thank you so much, Chris. Really enjoyed this conversation, and thank you for taking the time to talk with us.
No problem. Thanks for having me on.
Big thanks to Chris for breaking down the ins and outs of surety bonds today. If this episode gave you a new perspective, make sure you like, subscribe, and share it with someone in your network who needs to hear it. Follow us at ApprovedAF_licensing on Instagram, and make sure you leave us a 5-star review wherever you're listening. Remember, your licenses, your compliance, and your growth all depend on staying informed. So until next time, stay licensed, stay compliant, and stay approved AF.